my name is Tony Shorthole. I'm thankful to BEREC for the opportunity to participate here today. My role is going to be fairly minimal. As Philippe said earlier, we're really just timekeepers and organisers and coordinators. The way this panel is going to work is a little bit different to the previous panel. We're going to have an introductory discussion from Emanuele Tarantino, who's Professor of Economics at Mannheim University. And Emanuele is not necessarily focused in the telecom sector, but he has written some very interesting papers academic papers on mobile mergers and also on firm structure, whether integrated or separated. I think that's very relevant. So Emanuele is going to give us an introductory speech, and then the panel will react and discuss that, and then we'll go to the floor for some interventions. So I will introduce the other panelists, as I call them. So Emanuele, if I can, I give you the floor.
OK. So, yeah. So how it works exactly? OK. So first of all, I would like to myself thank the organizers for having me here and introduce the discussion on this very interesting panel, at least from my perspective, about the relationship between competition and investments in telecoms. I would also like to thank a lot Tony, Joe, and John for very fruitful and insightful discussions in the weeks coming to this meeting. Now, my job today is to talk about how the new European Electronic Communications Code is likely to affect the decisions taken by operators to invest in new infrastructures or technologies through the lens, and that's an important remark, of the mostly recent academic literature on economics, industrial organization, and competition. So why the code is relevant at all? And the reason is that it sets a new objective for national regulatory authorities, which is to promote connectivity on very high capacity networks across Europe. Now, in the code, there is a greater focus on promotion of investments, and this substantiates in a move away from a traditional technological neutrality approach. More specifically, from a general goal of promoting and fostering investments, the code moves to a more concrete identification of what are the specific investments that must be carried out. To make an example, think of fixed line. The question is, how can we make sure that there are right incentives to invest in bringing fiber to a new building? OK, so in the talk, I want to make a very clear distinction, even though I understand that industry dynamics are blurring these lines, between the mobile market and the fixed line market. And the emphasis in the mobile market will be essentially on the horizontal dimension of the industry, meaning talking about horizontal mergers and innovation, talking about the role of network sharing agreements. While in the fixed line market, I will give more emphasis to the vertical structure of the market, and in particular on the role and impact of wholesale-only operators. So let me start with the mobile line industry. Now, the fundamental challenge of the operators in this market is the transition to 5G. Now, this means that by increasing the frequency range, they're going to be able to achieve networks with higher capacity. But on the other hand, this will happen with poorer propagation than 4G. So now we have a trade-off, and we need to understand how to improve propagation quality. And to do that, network operators need to invest in much denser networks. This is not new. It's not new because we already had this discussion in the context of the transition to 4G. On the other hand, this is exactly the technological claim at the core of the need for consolidation that has been put forward by operators in the industry. And here I'm mentioning a number of articles in the business press. I could mention more. There's been a very active debate, both on the policy and academic arena, about whether mergers are able to promote investments or not. There is an alternative narrative to the technological view, and this narrative is based on the financial view. Essentially, is based on the role of financial constraints. The argument goes as follows. Standalone entities are maybe lacking financial resources to invest in new technologies. Merger fixes this by giving higher profits, and in this way implement projects that would be otherwise unfeasible. So I will touch upon these two views, the technological view for mergers and the financial view for mergers in my slides. Let me start with the technological view. Here, the discussion will be always thinking about the two main modes for integration that are there on the market, that we observe from the market. In one, network sharing agreements, operators share the network but compete independently on the market. And this is the case, for instance, in the Irish market, where despite the presence of 3 operators, there are only 2 networks. But also happens in other countries, like in UK and Denmark, and for example. An alternative, of course, is a full-fledged merger in which firms join both the investment and pricing units and decisions. Here, there are many examples. Just to mention the case of 4-to-3 mergers going on in Europe. Those were approved in Austria, Germany, Ireland, Italy, were rejected in UK and Denmark by the European Commission. Now, the fundamental question is, what happens to investments and prices if there is a merger? And what happens differently from mergers under network sharing agreements on investment and prices. So the differential implications of these two modes for the main outcomes of interest is what I'm going to talk about in what follows. So in particular, there's been a growing academic literature answering this question in the last few years. And more applicable to the context under consideration is I believe, a work that I have with Massimo Motta and another work by Marc Bourreau and Bruno Julien. Okay? The relevance of my work with Massimo is that essentially we provide a rather general analysis of mergers and network sharing agreements and their impact on prices and investments that can be used to study the phenomenon of mergers in telecoms. But the work of Marc and Bruno Julien is proposing a slightly different view, because at the core of their work is this idea of, let's see what is the implication for coverage when a merger takes place. And coverage is an aspect that seems to be particularly important in the context of the transition to 5G. I will finally talk about the empirical literature and see whether we have any clear evidence on the impacts of mergers on prices and investments. Okay, so I'll start with my work, what we do with Massimo. There we propose essentially a model of oligopoly industries with barriers to entry. It seems to be suitable for studying telecoms. And what is important is in this context, firms offer differentiated services. They decide on the tariffs to set to consumers on these services, but also on the investments. And investments in this context can be both cost-reducing and quality-increasing. When I mean cost-reducing, I think of, for instance, investments in reducing marginal cost of transmission of information along the line. What I mean about quality increasing is, for instance, boosting quality of the service provided to consumers. So both cases are considered. Now, what is the takeaway of our work is that absent efficiency gains, mergers tend to be welfare detrimental in the sense they increase prices and lower investments. And we show also that network sharing agreements tend to dominate in terms of welfare, meaning investments and prices, the effects of a merger. But let me develop the arguments that lead to our conclusions, and I will do that in 2 steps. First, I will talk about the impact of mergers on prices, and then the impact of mergers on investments. Now, on the pricing side, the idea behind our result that mergers increases prices really based on a simple upward pricing pressure mechanism. Once in the merger, the merging party, each of the merging party takes into account that when lowering the price of one of its services, what will happen is that its own market share is going to expand, but also the market share of the other merging party is going to reduce because products are substitutes. By that, the merger introduces an incentive to raise prices with respect to the pre-merger situation. Now, put differently, but the mechanism is exactly the same. Suppose that I merge with another firm offering imperfect substitute with respect to services with respect to mine. After the merger, I realize that if I raise my price a bit, part of the consumers that don't buy from me anymore will not go to some other independent competing firm, so will go to my merging party. By that, I realized that I can afford raising tariffs without losing consumers taking the merger as a whole. So this is the upward pricing pressure mechanism behind mergers that is typically at the core of any academic and policy work on mergers. Now let's try to understand what is the impact of this fundamental mechanism on investments, because the two sides are intrinsically related. Indeed, after merging parties increase their prices, they're going to have a fall in their market shares, in their customer base. And what it means that the services they provide in terms of volume will reduce. And since incentives to invest are directly proportional to the market base of a firm, as a result of the merger, merging firms will reduce their investments. Okay? So at this point, what I just said is that merging firms are very likely increase prices and reduce investment, but I haven't talked about the outsiders. So those who are outside the merging parties, what is their reaction to this action taken by the merging firms? Well, outsiders will also tend to increase prices because of reduction in competitive pressure, but this will happen by less than the merging firms. So their market share is likely to increase, which means a stronger incentive for investments. So now we have a picture that is a bit conflicting, because we seem to have that all firms raise prices, but some, the outsiders, will increase investments, and some, the insiders, will decrease investments out of this theoretical analysis. So what is it possible to sum up these phenomena, these effects? And this is our main contribution. Indeed, we show that absent efficiency gains, what happens is that total investments and consumer surplus will fall, and only the presence of sufficiently strong economies generated by the merger will make the merger consumer welfare increasing. Now you may ask, what do we learn from this, and what can we learn for policy formulation? Can we propose an alternative to merger that is likely to fix these inefficiencies and reduction of consumer surplus? And for that, we study network sharing agreements, which is something that is observed in this market. And how do we approach network sharing agreements? Our idea is that firms compete independently on the market, so each of them sets prices independent, but at the same time take investment decisions jointly. Now, thinking about the fit of this approach to telecoms, the idea is that firms set tariffs to consumers independently, but when they have to build an antenna or any infrastructure, they take decisions jointly. Okay? And what we find is that the network sharing agreement for given efficiency gains that are generated by the merger is likely to improve on the merger, meaning generating higher investments and lower prices. And the intuition is fairly standard. It's simply that by taking pricing decision independently, the upward pricing pressure that is induced by the merger is taken care of. And what you have is only the beneficial effect of coordinating on investment decisions. Okay, so now I want to give a short account of an alternative view to ours, which has been developed by Marc Bourreau and Bruno Julien in their work, in which there are two firms, so the analysis is more specific, which need to take choices on what? On prices, but also on coverage. And this seems particularly compelling to study telecoms because, deciding on coverage is equivalent to network expansion, essentially. So where I put my antennas. Now, what they find is that the merger to monopoly, because this is what the merger is in this context, yields higher prices, but also wider coverage. Now, the mechanism behind is the same as in our work, in the sense that there is this upward pricing pressure that brings up prices set by the merging parties. But at the same time, they also find that this corresponds to a greater incentives to expand networks for firms in the model. Now, 2 words of caution. This is a trade-off that, of course, makes the outcome less clear-cut than in our model, and that can result in a pro-competitive merger. But it's still true that the network sharing agreement, even in this context, is likely to do better. Now, I've now reviewed 2 works that represent the development of the academic literature from the theoretical side on how to study mergers and investments. Let me see what data say. In particular, I've been doing this, taking seriously, or as much serious as a model can allow me to do, the technological view. We need to merge because merger allows to increase incentives to invest. What the data say? Well, here I present the results, in particular of the work by Genakos, Valletti, and Verboven that use a very comprehensive data set from telecoms around Europe, well, not only Europe, in fact, data on pricing and capital expenditures, which is their proxy for investments. And we have 33 countries and 12 years. So it's a very big data set, very detailed, and they study what they do. They simulate the effects in these markets of hypothetical symmetric 4-to-3 mergers. So what they do, they set up their empirical model, estimate the model on the data, get their estimates, and try to understand whether going from 4 to 3 firms in a market gives higher prices, lower prices, and what happens on investments. Now, what they find is that the upward pricing pressure is at work in the sense that there is an increase in prices. There is also an increase in per capita investments that is weak, but there is no evidence of increase in total investments. So, all in all, these results seem to lend support to the theoretical results in our paper with Massimo, because essentially we are finding precisely this. There is an increase in prices and investments that are very likely to fall as well. Now, before switching to the fixed line market, I would like to briefly talk about the financial view. The argument that mergers are good because they reduce financial constraints. Here, the idea is that the merger relaxes limited access to capital markets for firms by essentially allowing for new investment projects that would not be feasible otherwise. Okay, so I am an operator, I am a small operator, a new entrant, I have limited financial resources, limited pocket debt, but I want to take an investment project that is very likely to bring me advantage on the market and cannot do that. The presumption is that, well, if I merge, I'm going to be able to increase profits, and by those profits, I'm also able to implement projects that would otherwise be unfeasible. Okay, so here there is a clear trade-off, and what is extremely important from a public policy formulation point of view is the quantitative assessment of the two legs of the trade-off, in the sense that it might be true that the merger brings about projects that would otherwise be unfeasible, but never forget that the upward pricing pressure coming with the merger is going to stay there on the power market independently of these considerations on the investment side. So it is important to understand what are the real gains in terms of relaxation of financial constraints. Now, in this sense, and in any case, for operators to be credible in making these claims, they, of course, must substantiate the presence of financial constraints. Okay, so let me now talk about the fixed line market. Here, as I said, my focus is going to be on the vertical dimension of the market, and the reason is that the new development in the industry is that it's growing vertical. And in particular, the questions are about the incentives for wholesale-only operator to invest in upstream infrastructure technologies. So here, I'm going to spend my time looking at wholesale-only operators, which are firms that invest to build physical networks, but stay out of the retail market. And there are a number of examples around Europe. The business model is essential to offer access to service providers that then compete with incumbents on the retail market. Good. So what is the main question I want to address in what follows? The question is, what market structure is likely to generate higher investments at the upstream segment, one that is vertically integrated or one that is vertically separated? Okay? So which of the two market structures is likely to generate a higher rate of return of capital investment? A vertically integrated or a vertically specialized market. Now, to make an even more concrete example, suppose a wholesale operator merges with a retail network provider. So what happens? Will this integrated firm still have enough incentives to invest on the upstream segment? Yes or no? Now, to answer this question, there is no clear academic reference studying the impact of market structure and the vertical side of investments, but there is a vast literature that really looks at the pricing decisions of upstream suppliers that offer service access to their essential infrastructure to downstream competitors that under bilateral negotiations, which seems to be a pretty good approximation of what is going on in this industry. And my presumption, as arguable as it can be, is that the industry that is likely to generate integrated or separated higher profits, profitability, and returns for the upstream firm is the one that will bring about stronger incentives to invest. Okay? Now, the crucial point to answer this question is what is the contracting environment under which upstream firms, wholesale operators, deal with downstream firms, retail service providers? In particular, what's the relative market power, and what is the structure of the tariffs that they're going to be able to set? Now, let me discuss point 1 and point 2 in detail in the next slides. In particular, I will start with market power. And the role of market power, I guess, is not controversial. It's clear that if a firm has stronger bargaining power in negotiation, it's going to extract more rents out of the bilateral relationship with the downstream firm, and that gives arguably stronger returns to investments. Now, here I'm going to, and in this section more than in the one on horizontal mergers, pose more questions and answers. I'm trying to pose questions, trying to understand what is the real situation that we face when looking at wholesale-only operator. In this particular slide, my question is, do these operators enjoy considerable market power vis-a-vis their downstream firms, yes or no? Okay? The first claim is in support of this argument, of this position, and the second claim poses some countervailing considerations. Okay, so let me take the view that wholesale operators have market power. What are the supporting claims, arguments to this claim? Sorry. Well, first is that they enjoy regulatory exemptions. So essentially, they are not subject to the same strict requirements in granting access to retail network operators, but only the regulation only compels them to guarantee fair and reasonable access to downstream network providers. There is another argument supporting the claim, and it's relying on market developments. Essentially, some of these wholesale operators result from a disintegration of integrated firm that used to be the incumbent, like Cetin in Czech Republic. And now the point is that if I am an upstream firm coming from an incumbent, resulting from an incumbent firm, then I'm very likely to enjoy strong position in a negotiation, especially with smaller downstream firms. So what is the countervailing considerations to the idea that upstream wholesale only are strong in negotiations? Well, it's that the fact that we observe asymmetric market structures is very likely to erode the bargaining power of wholesale-only operators. Why? Because vertically integrated incumbent operators are subject to regulation, which brings down their tariffs. If this is the case, even though they offer imperfect substitute, you may still have at a sufficiently low tariffs, there is some demand substitution going on, and this limits rent destruction from the point of view of wholesale only. Now, let me spend some time on the role of tariffs, because tariffs in bilateral negotiations play a very important role determining the profitability of a venture, in the sense of determining the deal by which an upstream firm can extract rents from the downstream market. Now, the problem with the pure linear tariff is that the supplier obtains only part of the revenues it contributes to generate from the downstream market. What is the beneficial role of fixed access fees? Well, first of all, instead, they eliminate double marginalization, which is good for everybody, consumers and firms, and guarantee also the participation of the upstream firm into the profits generated on the revenues generated on the downstream market. So the idea is if you are able to impose substantial nonlinear tariffs, then profitability is higher and rate of returns are going to be higher too. Now, can we think of situations in which this is not possible for wholesale-only operators? Well, one we just discussed is the fact that wholesale-only operators sometimes compete with other firms that are subject to regulation, and this reduces the leeway they have in raising fixed access fees. But there is another consideration that seems to be important as well. If I am a wholesale-only operator dealing with small network providers at the retail level, well, these firms may have risk aversion against uncertainty on the demand on the downstream market, and by that be very reluctant to pay upfront large access fees. So, okay, I'm close to conclude. What consequences for investments? So what I just said is that there are two situations in which rent extraction from the wholesale-only operator point of view can be limited, can be constrained. One is coming from regulation and the asymmetric structure of the market. And the other is coming from the fact that some operators downstream may be reluctant to pay high upfront access fees in the face of uncertainty and risk aversion. So if these two considerations and these two situations are important in in some market scenarios and settings, then we should expect the wholesale-only operators to face probably lower rate of returns from investments than in a vertically integrated firm. Indeed, what happens under vertical integration is that all of what I just said is not particularly relevant, especially when talking about a limited rent extraction from a contractual point of view. And the reason is simple. Now, being integrated with a downstream network provider, I have full grip on the revenues generated downstream, and this constraint fails to hold. Okay? Of course, it's very important, and I think it has to be very much remarked, that benefits from an increase in the rate of return of capital coming from integration should be always balanced against the potential abuse of market power that a vertically integrated firm can have by foreclosing, for instance, downstream rivals. Now, but for that, here I invoke, and this is why we have regulation and antitrust. I mean, that regulation and antitrust are there to prevent exactly this abuse of market power. And of course, I also invoke the fact that there seems to be relatively active competition, both at the downstream and the upstream level, limit incentives to engage in foreclosure. Okay, so this is the end of my talk.
That's perfect. Thank you, Emanuele. So now, very briefly, I mean, you have the bios of my panelists in the brochures, but I'll give them a moment just to reflect on that, because we're going to go from what was an excellent academic and theoretical discussion on these issues to, I guess, what will probably be more practical observations on these subjects. To discuss that, we have on my right Frank Sixt, who is Finance Director of Hutchison Whampoa Group, who is one of the best known and best regarded businessmen in Asia and even worldwide. He invests in a large number of sectors, in investments in utilities as well as telecoms, and I think it'll be very interesting to get his observations. On my immediate left, I have Gabrielle Gauthier, who I'm sure almost everybody here knows, who's worked in industry with Alcatel-Lucent. You may have known her from RCEP or ART, and more recently with Caisse de Dépôt as an investor. I have Jonathan Dan from RBC Capital, who again, many of you will know, who's been following the sector for a very long time, I won't even say. And to my right here, I have Martin Rulrich, who is a partner with McKinsey Group, who has very interesting insights and an awful lot of experience to share with us. Frank, if I can go to you first and get your observations or initial comments.
Okay, well, the first thing is I want to thank our hosts at BEREC for inviting me. Honestly, I don't get to spend anywhere near as much time as I would like to in this milieu, and it's nice to find so many familiar faces here. And when I say things that may sound negative in terms of the report card on telecom legislation regulation in general, right, in the Eurozone countries, that's not reflecting particularly on BEREC, right? I'm talking in general terms about how I see the impact, right, that the political and regulatory environment has had, right, on the sector, the development of the sector, right, as a whole. So please don't take anything that I say as being aimed at BEREC. And one thing you can be sure is that to the extent that you accelerate what you were talking about, a policy of early engagement right, in the development, right, of recommendations and so on in the BEREC context, right, and involve industry in that, you can be absolutely sure that I'll be directing our group to be very active participants in the earliest stages that you allow us to be, because I think we are very much, as many people have said today, at a turning point in this industry. And we have to get an awful lot of things right, and we have to get them right in the next 2 to 5 years, right? To focus a little bit on the negative, if we don't, right, we will not just lose the jobs associated, right, with a faster rather than a slower investment phase, right, in things like 5Gs, in things like high-speed wireless development, right? But we'll also lose out on the jobs of the future, right, which are so terribly important, right? This is, in the end, to me, right, about jobs. Every time that Amazon creates a job, they destroy 2.5 jobs in the conventional world of employment. One of the areas of hope, right, looking forward, is in the development, right, of the technologies that will surround things like radical new access environments, 5G, and so forth. And so we need to develop, right, policies at every level, right, that will maximize the opportunity to capture those jobs. And if we don't, I think we're doing, and I include the industry in this, we're doing a huge disservice, right, to all of our constituencies. So how do I react, right, to where we are right now? I think the picture, sadly, is a little bit grim. I look at ourselves, right, about 30% of our earnings, right, come from telecoms. About 36% of our earnings come from other infrastructure investments, including water utilities, gas utilities, electricity distribution utilities, rail cars, rolling stock, aircraft leasing, all basic infrastructure type investments, some regulated, some not regulated. Over the last 10 years, we have probably allocated our new investments, right, more or less in line, right, with where contributions have come out. It varies over time, right? In the last 2 years, right, we have spent about $35 billion in new investments. Out of that, about $30 billion has been allocated to the infrastructure categories that I've been talking about, and about $2.5 billion has been allocated to new adventures, right, in our telecoms world, right? That's running at a ratio of 9 to 1, right? And if that's the way that we're thinking, right, I think that that is potentially a little bit of a canary in the coal mine, right, type of indicator, right, for the European telecom scenes as a whole. It's not a big surprise. You need to stand back, right, and look at the bigger picture. What has happened to the cost of capital in the telecoms industry? Right? You've had, right, an industry go from investors demanding a 5% return to today, you take the average mobile company in Europe is trading at 4 or 5 times EBITDA, or 5 or 6 times EBITDA. That means investors are demanding a 20%, maybe even a 25%, right, equity return. You look at what's going on in debt capital markets. Rates are going up, right? The ratings of telecoms operators, right, in the world as a whole, but particularly in Europe, the credit ratings are under stress. Most of them, right, are relatively low investment grade or non-investment grade issuers, right? Basically, the cost of debt, right, in those categories is going up very significantly. And so, the risk here, right, is that this increased cost of capital translates into a lack of availability of capital. That translates into a lack of availability to invest, which means either that less investment gets done or the same amount of investment gets done, but it gets done a lot more slowly. And one of the huge risks that I see in all of this, interestingly enough, is that the much beloved, like, sort of mavericks and new entrants of the competition regulators are amongst the most vulnerable. These guys have seen their cost of capital soar, and frankly, a number of them are being pushed to the brink, right? And so I think that the whole environment, right, of local regulators, local governments, organizations like BEREC, the European Commission, the European Parliament, need to direct their thinking, right, towards improving, right, the access and the cost of capital to the European telecoms industry as a whole in order to shore up an industrial policy which will favor, right, more rather than less investment sooner rather than later in accelerating telecom services in Europe.
Thanks, Frank. I think, sorry, thanks, Frank. I think one of the issues there is about the cost of capital and the risk that's associated. Gabrielle, I don't know if you'll address this in your comments, particularly in relation to the wholesale-only model, perhaps. Yeah.
Yes. We have been, I'm going to talk from, as you say, from the point of view of the investor, but also it's the second time I am with the Caisse des Dépôts, and we have started this investment in fiber networks with a clear vision of what they were. And you all know, I think, the three-layered model. And I fully agree with what Frank says, but I am not the same investor as he is, and not on the same layer. And the problem is, what exactly are we talking about? And let me just go back a little bit as to what is an NGA. And when we wanted, and as you said, I've been tackling that as a regulator 10 years ago, as at the Comics of Alcatalius in trying to help governments. Everybody wants to promote investment, but what is the promotion of the right investment? It can lead to either, you know, and which investment, and what is future-proof? And I think we have to recognize collectively that we have not been very courageous in, and I am also an investor in energy like Frank and other sectors. Our sector has faced difficulty because we have been opening up to competition before the big surge of NGA, before the big investment, which is not the case of railroads, which is not the case of energy. And our mind was set with buzzwords that did not mean much. Sorry, but infrastructure competition, it has taken us 4, 5, 6 years to realize that there was one missing word. Because then we had to mitigate this silly thinking that on 80% of a country you should have passive infrastructure competition, which is totally, I mean, in France, up the front, we knew that on 80% of the country you could not face passive infrastructure competition if you wanted to still have active competition on top. So it's a paradox that you needed to recognize that passive infrastructure and ducts and blah, 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 which is 80% of the cost, was an essential infrastructure, that we did not have the courage to face it and treat it as such. Because we had in our mind that, yes, we have been actively promoting infrastructure competition with one missing word: active infrastructure on top of commonly passive shared networks, being ducts, being towers, being the rest. So when you consider it as this, and when you, network sharing is just a pis-aller, it leads to network sharing, can lead to oligopolies, even worse than as not the full-fledged of competition for regulators. Now, in France, we from the start, said, because of state aid, on 60% of the territory, this is going to be an essential infrastructure. How do we face it if we still want competition? And how can we make this bankable for investors? Not the type of investors, the private equity investors that want 2 or 3 years return on their investment, but is it not fit for long-term investors, pension funds, that seek for low risk but long-term, which is our case at the Caisse des Dépôts, so that it can boom, I agree with Frank, on top of it. So, and the fact is now I can talk about it more easily because we have 5 or 6 years behind us with this vision, which is perhaps a little controversial, which is hurting feelings, a lot of feelings, because it goes back to what exactly is can lead to philosophical questions. What exactly is an operator? And where does it start when you have the 3 layers? Having been with Alcatel-Lucent for 6 years, I can tell you that the fiber is the only future-proof. The other thing that I liked very much about the presentation that we had, thank you, was that the other wrong dogma was the technological neutrality. I mean, of course, mobile, 5G, 4G will never be able to compete with fiber. It's something else, it's something complementary. So when you face its market equivalent, I mean, these are wrong ideas. Even cable now, even VDSL, the countries that have been, yes, and it was good to bring the best out of the copper with VDSL, are now facing the challenge. Now what is next? And fiber is, the first layer fiber is future-proof. It's 80% of the cost. It's there for 50 years, whereas with Alcatel-Lucent, the gravity of the sector is towards network function virtualization, software-defined networks. An operator is going to have active infrastructure, GPONs, electronics, and I can tell you that's what we were selling at Alcatel-Lucent, and you have to have differentiation there. So long-term investors are fit for the first layer. And I can tell you, yes, you make money out of it. And yes, of course, then it's up to the regulators and up to set up the right wholesale catalog. Not only imposing co-investment, which leads to oligopoly, but imposing a whole set of there are some who wants to invest in infrastructure. Other operators, and perhaps we will see with 5G, whether the future of 5G is not also, if wholesale models are not the future of 5G as well. So the future of mobile is fixed.
I mean, I think we will see, we'll see in the future a kind of a natural experiment, because we do have vertically integrated fiber networks. We do have wholesale-only fiber networks. So I think over time we're going to get sort of an answer, I think, perhaps to some of the questions Emanuela has raised. John, can I get your reaction, please?
Of course. I mean, so given that this is a room mostly full of regulators, and BEREC's role is, I guess, to bring together regulators, I mean, I guess I'll have to ask the audience to forgive me in about what I'm about to say, and I basically say what I'm going to say with massive respect, admiration. I mean, Tarantino, it reminds me of my own chemistry PhD 20 years ago, where we were looking at experiments that would happen in outer space at 4 Kelvin. And that wasn't applied to the real world, luckily for the real world. So I think, you know, I think in a group of regulators, I think the challenge is we're at peak regulation. And if you will forgive me, you know, the regulators, we're approaching the point where we're the own worst enemy. I mean, I've a friend of mine who is a policy advisor to a big telco. And what he tells me is when the code comes out, they don't go and visit the CEO and explain the policy. They go to the CEO and explain the top 10 objections. So you're basically in this sort of misinformation world, despite all the excellent and very elegant research. And so, you know, if I give just a couple of simple examples, you know, at the FT Ethno conference, there's a very nice YouTube clip with Mr. Paete of Telefonica effectively bemoaning the fate of the sector in the last 10 years. The whole debate around net neutrality. You know, one of the new things in the communication code is this idea of promoting high-speed networks and also take-up. But I don't see any sort of discussion around, you know, why currently is take-up sort of give or take around 30%. And so I guess my advice, for what it's worth, you know, all the consultants do an excellent job, but they basically help on half the job. They do 100% and do a superb job on helping frame the debate and helping frame the reports. But the stakeholder and shareholder engagement is very wanting. And, you know, just some easy ones, you know, net neutrality. It should be somebody had taking some advice from some real investors would have said, let's just divide this into 2 topics. Topic 1, social political. If you look up the price of a lawnmower on the web on Google last night, should today Amazon send you quotes for lawnmowers? That's too intrusive, you know, multiplied by all the other examples. But the other side of net neutrality, should you be able to strike wholesale bargains between network owners and users of your network. I think if those two issues were just logically separated, most of the net neutrality would fall into two camps where everybody agreed grooming your data is bad and should be stopped, and monetizing your network through wholesale partnerships is reasonable. If you promote connectivity, I guess we should start asking ourselves questions when Liberty Global produces the take-up data by literally road that they open, or if you look at the French data that ARCEP published superbly, you basically have about 30% of any fiber network is taken up after about 3 years. And yet in places like the UK and France, there's no price differential. So why aren't these networks being taken up as rapidly as the regulation is basically breaking the telcos? So I guess, we could go on at length, and I'll be drinking a glass of white wine after, and you can catch me. But I suppose, what are solutions? So in the real world, we have Český Telekom O2 has separated SETIN. And so what we could do is, we could set I think the French government and ARCEP have done a great, set a real policy around, say, mobile coverage or fiber. Regulators could decide, is SETIN the business model? Is that the future European policy for regulators? So if you separate your copper access network and you abide by a certain set of conditions, that is a viable future for solving this regulatory dilemma. And so I think, going forward, what policy needs is more real-world directives. And I suppose, I think we're at peak academic regulation. And if Europe and the world wants more fiber investment, you basically need real-world solutions that investors can go to BT and say, okay, BT, in the Czech Republic, SETIN has been separated, and as a result of that, this is what they get. And it's 2 years later or 3 years later, and this is what happened. We, the investors in BT, we want you to do the same, or vice versa, it hasn't worked, so please don't do it. That's my tuppence.
Thank you. I mean, we'll come back to this in the discussion, but I wonder about the levels of fiber investment, because I do have the impression that fiber investments in Europe are accelerating at the moment. Sorry, Martin, thank you for your patience. So, Jonathan sort of gave a backhanded compliment to consultants there. So perhaps you can give us your feedback on Manuel's presentation.
Sure, absolutely. So maybe just as an intro, and I'm going to react probably to a few things that were said. But just for me, from a consultant's point of view, I'm primarily with the operators. So most of the work I do is concentrated on advising them on investment strategies and basically taking a view on how you need to react in the market conditions that they're in. And that being said, maybe let me start with that, reflecting a bit what the others said. The telecom operators space is really in a bit of a dilemma. If you take really a step back and look at the ROIs that the telecom operator space was able to get out of all of the investments that were flowing in, it has fallen steadily. So over the last years, it's very close to the cost of capital. And in that situation, right, the question always is, of course, to what degree does it pay off for me to invest into massive infrastructure rollouts? On top of that, interestingly enough, if you take a view from the overall sector point of view, there are still players that are making quite a lot of money. I mean, think about the Googles. We had the example on data monetization. Think about the Apples of the world. If you take a profit pool view, in fact, the telecom operators have gone down over the last 6 years from a 60% share of the overall profit pool to 25%. Quite interestingly. Nonetheless, the telecom operator space is the part where most of the efforts in terms of regulation are spent on. I mean, there is a change now with Facebook and so on, obviously, but still. And that being said, I think we talked also a little bit about fixed and mobile and so on. In my view, most of the discussions that I see, it's becoming more and more a discussion of converged connectivity. The boundaries between the fiber investments that you need to do from a wired connection as well as what you need for backhauling in very dense 5G deployments is blurring a lot. So a lot of the operators, and by the way, a lot of the mergers, coming back to what you said, in my view, are taking a specific strategic stance to make sure that the infrastructure investments from their efficiency leverage best and make the capital investments as as lean as possible. And since 5G is going to need quite a bit of fiber, if you're not having access to a suitable infrastructure that you need from a backhaul point of view, you're basically in a big problem. One more thing I wanted to say, I think there are quite a lot of parallels to other utility sectors. We also do quite a bit of work, of course, with the electricity world, but there are fundamental differences to the telecom side. This is a sector, at least in my view, that has very predictable technology renewal cycles, and at a much faster pace than the typical utilities like water and gas and electricity do have. And by the way, in my view, this is also not going to change with fiber. Yes, of course, the passive infrastructure as such will be a major step, and it's going to be there for a long time, but the active equipment that operators need to invest in is going to change. You're going to have things like WDM, so wave division multiplexing, or other technologies that will boost the capacity you have on the individual line. And this is fundamental to the way how this industry needs to invest, and trying to achieve a regulatory stance that is trying to keep things stable is a bit contradictory to the kind of dynamics of the sector. So the final point I wanted to make on the separation, I really liked what you said. I think there is an open question out there. In my view, right, if you look at the cases like Četin in the Czech Republic, like if you look at it outside in, it looks like this was a great story. Essentially, investment levels went up. I think Kellner raised capex levels by 40%. There's a lot going on in terms of what the industry does and so on. However, from a shareholder's point of view, in my view, a lot of the return and the increase of the multiples was coming because there was a calming effect on the regulatory environment. And if you, maybe as a final note, we have done recently some analysis. If you take an investor's perspective and ask yourself, what is one of the biggest factors that they put in from a risk point of view? It's not market risk, because demand is going to go up. It's not going to be operational risk. Most of the operators know how to do their stuff, but it's regulatory risk. Nobody can tell you whether in 5 years anchor prices are going to go up, down, or whatever. And that's a major point that is causing some problems.
Sorry, Manuel, did you have any observations on those comments, or?
Yeah, so my question for the panel is essentially related to this pressure that there seems to be on financial markets for telecoms, but in particular in the access to financial market, building up on what Frank was mentioning. And I would like to have your views on how a merger guarantees going out, and consolidation going out of this pressure, and if you think the reasons, the causes of this pressure are intrinsic to the business model of these firms or to the regulatory risk. What is that brings about this situation?
Frank?
Well, I'll elaborate a little bit more on the first one. I think the report card speaks for itself, and something that you brought up. I mean, if you look at the top 5 telcos in the world, right, they've created in the last 10 years about $80 billion of firm value. You look at the top 5 digital companies in the world, and they've created about $3.5 trillion, right, worth of value, right? So, why is it that there hasn't been a substantial reset, right, in the thinking around something like net neutrality, right? It seems to me that this balance has become so profoundly imbalanced, right, that it is becoming a limiting force, right, on investment for the sector as a whole. I'm not going to talk specifically about competition policy, because everybody knows where our views are on that. We were involved in most of the examples that you brought out. We were involved in Austria, we were involved in Ireland, we were involved in the UK where we were rejected, and we were involved in Italy, where we've created a new entrant and seriously disrupted the market in a great many ways. We still think it was a good idea to do what we've done. So I'm not going to address that one. I let other people deal with what they think specifically of the impact of competition policy. But I go back to the point, right, that I think we need to take honest stock of where we are. You know, and honestly, when we look at that split, right, you know, $80 billion of value created in telcos in Europe, right, they were the laggards, right? The average industry over the last 10 years added 26% of firm value, right? Europe added 16%, the two players in the top 5, in 10 years, right? That translates also, right, into a split between what's going on in Europe and what's going on in America, right, which is disadvantageous, right, to Europe as a whole from an economic point of view.
Frank, would you invest in a wholesale-only operator as something which has, you know, better returns?
It's not his profile.
Sure. Well, it's an investment. It's,
Yes,
it's a utility-type infrastructure investment.
Yeah, but let's talk about that a little bit, because I mean, where that's going to come up, of course, is in 5G, right? I mean, 5G is going to be a universe where, you know, 4G plus, right, and more high-speed consumer broadband access is actually a very small part, right, of the business pie that's suggested by 5G. What's far, far more interesting is the ability to create virtual slices out of our networks, right, and offer them to different markets. Now, if there are asymmetries, right, because of regulation, right, if, for example, there's an asymmetry between how I can allocate, right, a slice of my networks, right, to developing a new business that requires a bespoke slice and that won't be available to the 4G++ consumer world, right, as opposed to creating that slice and selling it on a wholesale basis to a third-party player like, you know, a Facebook or a Google or whatever, right? Does that make any sense? Should there be an asymmetry? If at some point, right, in the overall balance of things, I've got a shortfall domestically of what I can provide in my 4G++ to broadband access consumers, right, is there a reason why I shouldn't be able to buy a slice, right, from my own competitor domestically, if you think of it that way? I think regulation today suggests that that may not be doable, right? I'm not sure about that, by the way, but you know, we're all learning as we go along with this stuff. But I think the real point that I'm making is that there's a vital task, right, to revisiting some sacred cows, right, and to creating an environment that has a lot more certainty in it, right, as to what how the investment in the next stages of telecoms, right, is going to be dealt with from a business point of view.
Sorry, Gabrielle, you said about maybe 5G also going to a wholesale-only model. Is that?
Yeah, no, just one point on the certainty. Let me go back on the attraction of investors, because just one point on how we have seen the landscape radically change in the last three years in France. Because, sorry to say that, because there was a framework that was set, and because there were contracts and tenders for long-term 25 years concessions on this fiber, specifically for the more rural areas. And today, I can tell you there is a rush. I was the only investor 10 years ago, as the Caisse des Dépôts. Today, I can't sometimes even, there is a rush, a dumping on the state aid. That means the last tenders that were issued, you have very little state aid to cover the more rural areas. I mean, it's half of France still. You had a rush of the Macquarie, Cube, Quaero, Marguerite of this world, so that the Caisse even sometimes couldn't get a share of these so valuable infrastructure that was tendered out. And what was it? It was a certainty, a contract, with commitments and penalties if you did not roll out, with obligations to open up, with a wholesale catalogue, and as the Caisse and a former regulator, we helped the local authorities set that up, with obligations of open access, and by the way, paradoxically, and with a great attraction of banks to lend, and of investors to invest. Now, this is the reality today in France. In fiber networks, it was not the case when we were discussing fiber as and paradoxically, I couldn't show this chart, it's rolling out much quicker than in the dense areas. Well, you left it to the market because you did not set the vision that it was a monopoly on 80%, an essential infrastructure that, yes, should be well regulated. But then the regulation is then done by the contract of the local authority, sometimes under the observation of ARCEP. But still, and there, the long-term money flows, infrastructure funds flow, because they have at last, which was not the case when we led the initiative with Neelie Kroes 5 years ago, our goal was to show long-term investors that our sector was worth investing. They were looking at roads, energy, utilities, because our sector was not recognized as a utility. And sorry to say, but fiber is a utility if we want to have active infrastructure competition, and I fully agree that the ambition of an operator is to have and to differentiate on active infrastructure, on the intelligence of the network, not in the duplication of ducts and dark fiber. So,
but you have a difficulty to constrain it to the rural areas. Oh, sorry, you have a difficulty in the urban areas, because if you have cable extensively deployed, you cannot have monopoly in very dense areas because the economics allows multiple deployments.
Well, there were different various reasons, especially state aid, because you need a little. It's the granting of as little money as possible that grants you that somebody else is not going to overlay. Yes, yeah, yeah. And that's the worst fear of long-term operators. And just our infrastructure competition dogma was scaring long-term, we have to understand this, investors, long-term investors, because we have not assessed that one of the layers was not fit for duplication and for infrastructure competition. Well, and now that in the areas where you do admit this, they flow.
Yes, but I think part of the problem too is that there weren't very many infrastructure products available. So investors didn't have the opportunity to invest. I think that was perhaps part of the problem.
Because, yeah, you're right, yeah. You're right.
I'm just going to ask Martin something, which is, we've spoken at length about wholesale only, and, in fairness, a lot of the provisions in the code, as I would see them, are some form of separation, so either wholesale only, even co-investment, you'll have different governance structures between the different layers and so on. But how should, for instance, traditional incumbent operators, because they're still going to be doing the heavy lifting in most instances, how do you expect them to react to these new operators? How should they react? Or
yeah, so maybe just to pick up, first of all, I wanted to say before going into that I think regulation can play a crucial role. It's not that this is like a bad story, and I think what has happened already is that, like you said, there is infrastructure competition happening in many markets, especially in those that were quite behind on the fiber rollout. I mean, look at what is happening in Germany with Deutsche Glasfaser, in the UK with Hyper Optic, and so on. And I think part of that that competition is quite healthy. Now the problem with it is, and I think that's also the stance most of the incumbents do take, most of these attackers are concentrating their efforts on the geographical areas where the ROI will be the highest, which are primarily densely populated areas with a good average household income. Generally, I do believe that that's very often not the area where, from an overall country point of view, you should worry most about. Because in these areas, there's a natural incentive to invest anyway. And so, so what will happen, in my view, is, and I mean, you see this by quite a few announcements, incumbents will take a defensive stance. So they will invest in fixed wireless access products like Verizon is doing, or like Deutsche Telekom is announcing, because essentially it's quick to roll out, it's cheap, yeah, they have very good, or very often very good mobile networks, and it destroys the business case for an attacker to invest. That still leaves quite a whole lot of country left where you're very often stuck with old copper networks. And so the question is, how do you get investment incentives up in these areas? I don't have a final answer there. I do believe that here regulators can really play a very important role to set the right incentives. I think there are different models out there. In Germany, it's primarily a scheme of subsidies. So there's quite a lot of money that is going to be poured in and auctioned, essentially. But it could be also others. I mean, why isn't there, if you look at other international markets outside of Europe, the willingness to pay of people for a higher service, high-speed network connectivity on wireless is quite high, actually. And why do you need uniformly anchor prices across the whole country? I mean, if you would relax that part a bit and allow prices to go up in more rural areas, I think that could lead to quite a bit more of an investment. And I think operators or incumbents are trying to go that way.
Sorry.
I just wanted to jump up. The model I was describing of a tender concession was concerning these areas in France, rural areas. And you had a commitment, a concession saying, and the take-up is higher than in denser areas because they're so hungry for. Yeah. So it's another paradox. There is a need, even a more urgent need. And the paradox is also that when you have a wholesale-only model, you have more. Another market we haven't spoken of is the business market. It's much more difficult to attract, and it's critical for the productivity of Europe. On these wholesale models, you have 4, 5, 6, sometimes 10 business operators which cannot flow on, in the denser parts. In France, this is the case. You have no competition in the denser parts, and you have competition in business in the less denser parts. And you have the paradox of small and medium businesses moving to the less dense areas because they're more and better covered, and they have competition for business. Another paradox of these models.
Can I ask about, or go back to 5G, and to ask where you see blockages in the rollout of 5G? Now, I think we understand that there are concerns about net neutrality, and I think, to play devil's advocate for a second, I think the regulators would say, look, there's nothing in the net neutrality regulations that would stop you deploying any of these services. They will become specialized services or whatever, that it can be covered under the current paradigm. But I think the fact that you've raised this, probably needs to be addressed. If you perceive a concern, then that itself probably is a concern. But aside from that issue, where else do we see the pinch points in 5G? You're smiling because you're saying you don't go beyond that point, but what about things like spectrum or
My goodness. Can I take that one?
Yeah, please.
I suppose the other issue that faces the industry, and again, I think drives the cost of capital in the wrong direction because it drives the risk perception in the wrong direction, right, is what I call the ATM effect, right? And unfortunately, right, it does happen that countries, regulators, politicians view, right, a successful industry as the telecoms industry, I would say, was, not as it is today, as an ATM. And so, when you get things like spectrum auctions, right, that are designed only to maximize income to the state, right? No design features at all that will lead to, right, a sensible allocation of spectrum, right, relative to the anticipated rollout and availability of services and so on. They don't look at that aspect. They only look at how much money the auction brings in. I actually think that that is totally counterproductive because the money that is taken out at that point in the cycle is simply money that's more difficult and more expensive to replace, right, as a result. And if that has an effect, right, it is to slow down, right, the rate at which investment in 5G happens.
What's the solution?
And
different auction design, more spectrum availability?
I think it's an objective, actually, I believe, right, to sort of come to a view on spectrum allocation, and some progress has been made in terms of the terms of spectrum licenses and so on. But as long as individual countries sort of go after that, or I'll give you another example, right, politicians, right, decide to take a dip into the industry's pocket. Why do we all of a sudden have price regulation on intra-European calls, right? And I believe that BEREC actually was not supportive of that, but it's pretty good for the politicians at the European Parliament, so what the heck, we'll dig the trough.
And in fact, it goes back to Gabrielle's point about clarity and certainty if things arise very quickly. Where else, Jonathan, do you... Yeah.
I was going to make 2 points. There already is a very effective copper-based neutral provider in every country. I mean, if you look at DSL market share of the non-incumbent, is typically 30 to 40% in most countries. And so I guess if OpenReach, if these neutral copper networks, currently they happen to be owned by the incumbent, I guess would they stand alone have voluntarily doubled their asset base, swapping copper to fiber, without clarity on the wholesale price? I think that would be an uncertain debate, but would the separate retailer, if BT or Orange did not own the copper network, would they be contracting with neutral brand new fiber networks to provide their customers with the brand new service at, say, instead of €7 to €9, 12 to 13? The retailer would probably be driving the rollout of these new networks. I guess the challenge for the copper owner, that theoretically separate, I guess their business, without any clarity on, well, they've got clarity if they basically pull out all the copper and push through fiber and reduct, their asset base is increasing significantly. And what they don't have is the industrial policy or the clarity that they will be able to charge a clear 10, 12, 14 euros. And I suppose importantly, they don't have the clarity about overbuild. So if you look at what's happening in France, so Altice is going to IPO or trade sale. It is going to sell the medium dense fiber network, so 20% of the medium dense areas, and they will also include the 2 million or so rural RIP network. So ultimately, it'll be a 2 million home passed today, growing to about 5 million home passed, guaranteed no overbuild, some uncertainty about rivalry between wireless or general market demand. You know, you can argue whether everyone will be a fiber customer or perhaps rural people for some ridiculous reason won't. But I guess in France, they've got a guarantee that there's no overbuild. And so you've had investors. And that'll be proved in the next few months when they manage to sell 50+1 share. I think in the UK, if you're City Fibre, I think they announced Leeds as city number 8 or 9. And although there's less than 4% of the UK is fibred, Leeds is one of the first cities that BT announced. Virgin has done some new fibre, and on any conference call for Virgin, the first question they get asked is, okay, you currently have 35% capex to sales. Can you enter into some form of partnerships with these new fibre builders and avoid overbuild? But in the UK, there is no policy to direct all the different builders and say to them, okay, it's most important for Britain in the short term to actually coordinate, and for the next 10 years, somebody do Warwick, somebody do Milton Keynes, and when we have 80, 90% coverage, by all means, overlap each other and compete.
We need to be a bit careful not to argue for monopoly in the future.
I don't think it's monopoly, though. It's
but we don't want to end up, we need to be careful that we don't end up back with one network.
But these are, from a consumer's perspective, most of these new networks are being paid for by retail companies like Vodafone, who are guaranteeing themselves a 3-year head start.
Exclusivity, yeah.
If you look at hyperoptic, it's not open for wholesale. Community fiber's not open for wholesale. So talk, I'm sure they'll give themselves some natural exclusivity. So I guess without policy, you're accidentally collapsing into exactly what you're trying to avoid.
One word perhaps about 5G. What is true is that 5G, of course, it's not only going to be small cells, but it's going to be a lot of small cells as well. It's not going to wave out the picocell, the femtocell, but you're going to have a lot. So it's, again, a need of increasing capex enormous. And the closer you get to the customer, the more the characteristic of the network is that of an essential infrastructure. So, and the more the wholesale model is favored. That's all I can say. And perhaps, and we have a lot of vertical other industries than our sector, the automobile industry. Do you think the automobile industry wants to engage into an exclusive partnership with one or two mobile operators? No. Do you think even the retail industry, I'm now sitting at the board of one of the big real estate industry, they are very much interested by 5G and seeing how do I equip my buildings. But the question they're asking me, who should I partner with? And it's a huge real estate in offices in Paris. Who should I engage with? No way I want to make an exclusive partnership, even for 5G, with this one or this one. They want a wholesale model. Sorry.
Right.